in 30 years of being in the multifamily industry, I've never seen anything like this. So that has actually reduced the amount of sort of stress or distressed assets that have made it onto the marketplace. The gap between the cost to own a home and rent a home has never been wider, like in anything we've recorded in 30, 40 years. Yes, supply is receding from ahistoric levels, very, very high. 26 is probably the final year of going through the COVID cycle. Clearly, artificial intelligence is moved to the fore because it's so generalizable and ripples through so many sectors of the economy, particularly the sort of intellectual capital components of the economy.
Welcome to our conversation with Jeff Adler, the Vice President of Yardi Matrix, one of the most comprehensive data tools out there. In our talk, we covered topics such as technology, the state of the affordable market, multifamily at large, and others. Please enjoy. Jeff, thank you for being with us again. I know we saw each other last fall when you gave us an update on the market and what was going on. So wanted to talk to you again, since we're right off the State of the Union speech, to kind of have a state of the market conversation, especially multifamily market. Because the latest Yardi Matrix National Multifamily Report points to the fact that a pretty lengthy downward trend in the rental market has been sort of curbed in January. Is that something that's here to stay? Are we seeing that as being sustainable? Or what's your view on what's going on right now?
Well, so I would say it's somewhat encouraging, but a bit tentative. And the reason I would say that is there tends to be a seasonal bounce in January. So fourth quarter tends to be the weakest part of the year. And so when the fourth quarter is strong, that's unusual. That's an indication of a very strong market. And when it's weak, like it was this past year, it isn't super unusual, though it did definitely trail down in a meaningful way in terms of overall absorption and rent growth. January is a little bit, normally you see a sort of sequential bounce. So the fact that there was a sequential bounce was itself good news, because if there hadn't been one, that would have been a further indication that there was a real demand pressure in the market. So I think it's a little bit on the tentative side, which is, boy, it could have been a lot worse. We also are seeing indicators of job growth through ADP and through other surveys being a tad better in January and February. I think the fourth quarter, who knows if it was affected by the economy or the government shutdown. Some of these things are tied together. But I would say that we're off to a decent start in January and February with rental market conditions. Not amazingly strong, fortunately not amazingly weak. And I can kind of walk into sort of our view on the forecast for the coming year, because I've been at the NMHC annual conference, which is like the big kickoff in the U.S. multifamily industry, and there was a lot of conversations about both supply and rents and occupancies, and so I'm ready to go into it. I'm ready, Alex. I'm ready. Put me in, coach.
Okay. Well, especially with the leasing season kind of coming in.
Yes.
Is there a view that this kind of slowdown or middling performance in multifamily, is that sort of a new normal we should be expecting, or
not?
Or not?
Yeah.
Really?
Well, the way to think about this, right, is from a supply standpoint, we are coming off of two incredibly ahistoric supply years. So 24 and 25 were very, very high. As we go into 26, we're still probably going to be something like, it's like 500, 450, something like that. And then we step down to like a 27 number, which is around 430,000 a year. That number includes about 70 to 80,000 affordable units. So it's important to understand that when I give you these numbers, we're talking about market rate, partially affordable, fully affordable, which is about 80, 90,000 units a year, as well as SFR BTR, about 20 to 30,000 units a year. So when you kind of strip out just looking at market rate and partially affordable, you're kind of in that 380 8.25% range. And we think that kind of levels out, okay? And that isn't enough supply to kind of resolve the housing shortage, but it's not so few that suddenly we're going to see these huge spikes in rent growth. We do not see that, okay? So we're kind of returning to a pre-COVID normal level of supply, 26 being sort of the final step down. So we think 26 and then 27 kind of levels out. But in that mix is about probably 50,000 more affordable units than had been the case kind of prior to COVID. So there 40,000 more than prior COVID years. So public policy to induce more affordable housing is having an effect. Okay, so that's the supply side of things, right? Which is, yes, supply is receding from historic levels, very, very high. 26 is probably the final year of going through the COVID cycle, and then you kind of level out. There was some sort of maybe hopes, wishes, and prayers that suddenly supply would suddenly collapse. And that's not the case. That's we just not happening. Then when you look at sort of rent and occupancy forecasts, there's clearly a separation between the Northeast and Midwest and sort of Sun Belt and Mountain West. The Sun Belt and Mountain West is where migration was the strongest, where rent growth was the fastest, and where the supply response has been the deepest.
Immediate.
Yeah.
Almost,
well, immediate, but I mean, everything in housing works with a lag.
Yeah.
Okay. So in this Northeast and Midwest, you did see increases in rents in COVID, 30 to 40%, and those rents are continuing to rise about 3 to 4% because you never really had a big supply response, and there wasn't a surge in population. Okay, and you never had that. You didn't have that huge spike, a sudden spike in rents. So those markets are sort of having their moment, as it were. They're also beneficiaries of reindustrialization, plays particularly in the Midwest. And to a certain extent, a number of them have large AI data centers and the ecosystem that's being built around those data centers, most notably, I think, New Albany in Ohio, outside of Columbus. So that's one whole ecosystem. Now, I also will throw in the San Francisco Bay Area, which really got beat up in COVID, is recovering from its COVID lows, okay? And particularly the San Jose and San Francisco, the peninsula, have been recovering. The demand has picked up. Those markets are definitely in recovery. We also saw both the AI, kind of boomlet happen or continuing to happen. Plus, there was a change in administration in San Francisco. So public policy did change around the same time. So both of those, so that's definitely sort of on. It's acting like a Northeast Midwest market. Okay. Now then you have the balance of the Sun Belt and Mountain West, and that's where units are getting absorbed, but not necessarily at the price people would have hoped they might be. And overall, sort of rent affordability is gradually improving because rents aren't going up as incomes continue to go up for those people who have jobs.
Right.
Okay.
Right.
So that is, I'll call it, a market that is going through a process of sort of recalibration. Now, inside of that is a very ahistoric and unique experience, is that the gap between the cost to own a home and rent a home has never been wider, like in anything we've recorded in 30, 40 years. That has had the effect of reducing the number of units that turn. It's also had the effect, because the population of renters is aging and is older than it otherwise would have been, is that those folks are renting at a higher rate than they otherwise would have, so they're not moving out, and they're paying more on those leases. That has had the effect as new leases have been being transacted. Those rents, what we call lease trade-outs, new lease trade-outs are negative. Renewal lease trade-outs are positive. And often the absolute spread is 6 or 7 points. In 30 years of being in the multifamily industry, I've never seen anything like this. So that is actually reduce the amount of sort of stress or distressed assets that have made it onto the marketplace because it's been provided some level of support.
It's been keeping them above water.
Keeping those owners above water. Okay. Now we have basically another year of this playing out. Okay. And again, if you look at demand, all the jobs that have been created are in the non-healthcare sector. So if you look at anything but healthcare, it's been flat to down, not monstrously down, but not growing. Remember, 86% of the U.S. economy is not healthcare. So for most Americans in the industry that they are involved in, right, they've been in sort of a flatline world.
Growth isn't happening.
Growth hasn't happened, right? So you have a little bit of consumer crankiness, particularly at the lower end of the economic scale. People who do have jobs are getting increases. Overall inflation, as measured by PCE or CPI, is, I'll call it, between 2.5 and 3. Average hourly earnings, call it 3.5, 3.7. So objectively, one should say, oh, well then, real incomes are growing 1%. Doesn't feel that way so much because there is a real spread between higher income and lower income Americans. So both the inflation rate that lower income Americans face is higher than the average, and the wage growth that they are obtaining is lower than the average. So when you look at this split between lower income Americans, I'll call it class B to C and class B plus to A, there is a separation. We see it in the rent to income ratios, much higher for those folks who are lower income Americans than higher income Americans. So there's these geographic kind of components that are playing out. There's these income levels that are playing out. So there's a lot of variation right now. So it's hard to kind of come down and say there's a universal theme. There's there's a geographic theme
trend,
and there's a product theme, and they're both playing themselves out, by market. And some markets are on the path to recovery sooner than others. And I would just highlight, I happen to live in Denver. Denver's got another problem in that its economic growth has stalled due to public policy. So it's not getting in-migration as it used to in a meaningful way in the past. It's not getting the level of economic growth. It's still having a fair amount of supply come in. And so you don't have the bounce in the Denver market that you're seeing somewhere, let's say in Nashville or Charlotte or some of the other sort of Sunbelt markets. So it's a very, very sort of, differentiated market this year. It's going to be a very challenging market to navigate. I do think there will be an increase we're already seeing about a 15% increase year over year in sales transactions, properties trading. I do think we'll see more stressed or under stress assets getting resolved in some format, where the current equity holder has to basically take a cut. Not the debt. I think the debt holders are going to be fine, but the equity holder is going to be pushed
to be under pressure.
Be under pressure to basically, a forced refi, a forced resolution. That maybe the year one extension is like they're out of time and they got to deal with reality. I think more of those will happen this coming year. So that's kind of where, like, if you kind of look at the overall landscape, the emphasis clearly is in how do you keep people in the apartments, because retention, losing people, it's very expensive, particularly, again, in the Sun Belt. And how do you control expenses, right, without degrading the sort of product or the experience? Because again, if you degrade the product, you're going to lose people, and that's going to be a very expensive. So it's almost, I would say, kind of back to the old school. Like, you really got to grind out results. There's no easy money here. Especially
since you mentioned that, like, renewals are like way ahead.
Yeah, you losing a renewal is a very expensive proposition because you've lost that higher paying rent customer. You're going to replace them with a lower rent pay, and you're going to have to advertise and prepare the unit for re-rental for the privilege of doing all that. So it's a very expensive proposition. And I do know, of course, that property managers are very focused on customer retention.
Mm-hmm. So with this increasingly granular dynamic you described from market to market, is that for data products such as Yardi Matrix, does that make it more difficult to stay on track of everything that needs to be tracked, or what? How do we interpret it?
Yeah, our data is extraordinarily granular, so it's kind of built in, in terms of both rent collection and occupancy collection and expenses and supply and all and sales transactions. So it's all granular in the first place. It takes a little more care to sort of interpret the results, as I would say, because the data exists at a very granular level.
Right.
So then it's just, it's aggregating up at a very low level or a kind of a high level of resolution into the detail so that you can tease out kind of the benefits. Also, well, what loans are coming due, and not just, securitized loans, but bank debt, debt fund debt, insurance company, construction loans. That's stuff that's a little bit harder to get that we do a pretty good job of obtaining. We estimate the debt service coverage ratio to kind of highlight those properties likely to be under stress. So I think that level of granularity kind of inures to our benefit.
As an asset right now.
Because in order to execute any kind of investment strategy, you do need to be much more granular than you may have been able to get away with in the past, because the broad strokes don't work quite as well. Though I was helping someone a couple of days ago that wanted to invest in the Midwest, or I think these guys were based in the Midwest. We were able to find lots of great acquisition candidates because the market's going up. We look for let's say a B asset in an A neighborhood. You look for a loan maturity. You look for a rent gap of $200, and it's like, okay, everything's lined up here. Now it's just a question of, what's the right price to offer to get into that asset.
The deal done.
Yeah, to get the deal done. But that is following a traditional acquisition value-add playbook without doing anything different. It's more, if you're in the Sun Belt, you got to be really careful about your entry point. You don't want to catch a falling knife. And so it's all about how to position yourself for that entry point. Now, if you're playing a development game, you're really thinking out 3 to 4 years. So you're thinking out, how do I be the folks who are going to deliver in 28, 29, and you're not really going to, I don't think you're going to catch this massive hockey stick, but you're going to be in an upward trend. But you also have to forecast how low you go down before that cusp comes in. Obviously, we have forecasts for that.
Right.
But there is some level of risk or uncertainty around what that number is. And it does make a difference, particularly in this environment. And with the cost of equity and debt capital not going down. I don't think it's going up much, but it's certainly not going down.
Okay, so talking about things that maybe are sort of counterintuitive in the industry. I think the latest affordable housing bulletin posted by Yardi Matrix shows us that in 2025, affordable assets actually tended to outperform traditional multifamily in NOI.
NOI growth, yeah.
NOI growth, yeah. Could you explain that?
What the heck is going on with that, right?
Because when I read that,
right. So I would the way I would assess that is affordable housing is a less volatile asset type than conventional multifamily, right? Conventional multifamily, rents go up, and when supply hits, rents come down. So it has more variability to it, and it's almost like a high beta stock, right? Versus a low beta stock. Each have their role to play, right? One is a more asset appreciation heavy. The other one is a tad more, let's call it income appreciation heavy, right? And affordable housing acts like a lower beta stock with a higher degree of income as opposed to capital appreciation in its return mix. And all we're seeing in 2025, we ran a full set of reports from Matrix Expert, which is the aggregation of the Voyager accounting data, looking at what happened with affordable housing across region and so forth. And it does indicate what you'd expect, right? NOI didn't go up as fast during the boom years, and now that sort of things have calmed down, it's not going. It's going up a bit more on a year-over-year basis. Okay, but that's because it's just a less volatile asset class.
Right. So it's essentially catching up.
It's catching up. Yeah, and it does take time. And remember, rent increases because they are a formula are by design lagging the market rate. They are structured that way based on what AMI increases, and they're capped at 6%. So it's kind of by design. It's going to be less volatile because it lags.
Okay. Yeah. So like more of a forward-looking stance here. Are there any specific things that you're looking at in the environment, in the technology environment, that kind of inform what you and the data product are looking at on a day-to-day basis? And is that any subject to change now?
Wow. So it's hard to talk about technology and not talk about artificial intelligence, right?
Of course.
And the impact of that. And there are other technologies out there as well, right? There's still energy production, there's energy storage. There's other, there's autonomous vehicles. There's other things that sometimes people forget that, there's a whole bunch of other ecosystems. But clearly, artificial intelligence is moved to the fore because it's so generalizable and ripples through so many sectors of the economy, particularly the sort of intellectual capital components of the economy and the services economy, where, frankly, most of employment lives. So you could break this into how artificial intelligence ripples through the general employment world and the demand for housing. That's one whole ecosystem. And the positive side of that is that we're talking about increasing labor force productivity, which is a really amazing, great thing for people who have jobs and have experience. So I'd say it's an unvarnished positive for people already in the workforce who are going to be able to upgrade their skills and be able to be compensated more highly for that. It's a little yet unclear about new entrants into the labor force, because that seems to be the place where businesses could easily say, and we also are beginning to see it come into even real estate finance organizations, where like, well, do I need 4 analysts? Maybe can I get away with 3, right? So, and the sort of cost reduction implications are non-trivial. And so that's a thing that's playing itself out. And how does that play itself out in demand for apartments? We don't entirely know what that is just yet. We've seen a little bit of an uptick in college age or college graduate unemployment rates, moving upward at a faster rate than other demographic groups. I have lots of anecdotes about programmers not getting hired. That would indicate that, we think it's having an impact on recent college graduates and that component of the labor force. So that's one part. The other part is just the way in which artificial intelligence is changing the way the data provider business model works, okay? And there is lots of interesting things that are occurring there, all of which definitely seem to be driving towards increased labor productivity. Certainly in our business, we are in a business of providing data on a subscription basis, we are seeing labor force productivity. We are seeing a decline in hiring of new employees. We're seeing a sustained decline in turnover. So the need for new employees is lower. Right? And we're seeing an increased level of innovation that kind of we're working on, not yet ready to announce. But the potential for increased levels of innovation are, again, interesting, non-trivial. We're all kind of trying to figure it out. if you claim that we knew what we were entirely doing, I think we would be absolutely lying.
Mm-hmm.
But we are participating in what is happening. Let's put it that way. And I think a lot of our clients are participating in what's happening, and we're sort of participating in this together as we try to figure out how to improve really the efficiency and effectiveness of all the things that we do. So it's kind of very exciting and thrilling, partially terrifying all at the same time. But we're definitely on a change in trajectory. Something's definitely different than it was even 2 to 3 years ago.
Mm-hmm.
There's clearly a change in tenor, a change in capability. It's an exciting time.
Jeff, thank you for all of your insight and for coming back to have a conversation with us. And we'll be sure to talk to you soon.
Great. It was great to talk to you. Thanks for being here.
Thank you. Thank you for your time.
Bye-bye.